Hello everyone and welcome to your Glassnode video report for week 42, 2023. So today we're going to be expanding our study of capital rotation. Last week we really looked at it on a macro view, how funds actually transfer and flow from Bitcoin down to Ethereum and then down to the long tail of assets, which we modeled through stablecoins. Here we're actually going to go internally and we're going to look at the capital rotation that occurs within Bitcoin itself. And this is really describing how coins change hands. They're moving from one investor to another. And with that, and the most important thing to recognize there is that the owner changes. That means they may go from a hodler to a speculator, but so too does their cost basis. And the cost basis changing is really what changes the dynamics of the market, because it's much easier to hold a coin that's in a significant profit with a low cost basis than it is to buy the top and see the market fall out from under you, especially if you are also a speculator or a new investor versus a high conviction hodler. So that's really what we're going to be exploring today, this cycle of Bitcoin changing hands. So capital rotation is a really interesting dynamic. It happens across all assets and all markets. It just happens to be that when we're looking at the on-chain data, we essentially get 10-minute resolution for Bitcoin to see how those macro flows are starting to change. Now, obviously, these things play out over different cycle lengths. When you get to bull market tops, there's a very, very significant distribution pressure from those long-term hodlers. At the same time, when we get down to market cycle lows, these price insensitive folks are the ones that establish the floor. But in between those two extremes, we have the short-term holders who tend to be this kind of hot ball of money that follows the price around. And what we're going to try and do here is actually model this out. Look at this distribution, how wealth moves from one party to the other. So we're going to come at this approach really coming back to the realized cap. You've probably heard me talking about this particular metric several times in recent videos. The realized cap is just such an important foundational metric. We have a whole video and a report titled as such. And what we're going to do here is take two different pieces or two different models using NUPL, which is one kind of crowd favorite metric, looking at the net unrealized profit and loss in the system. And we're also going to look at it from the perspective of the realized cap HODL waves. So taking two different instances of realized cap and showing you how we can develop two indicators that actually monitor the progress of this cycle. So as always, please do give us a rate, a share, and a subscribe. It does help this channel get to more people, and let's get stuck right into the analysis. Okay, so here we are starting in our week on chain 42 dashboard. Now, we're going to start just again, coming back to basics. What is the realized cap? Well, the realized cap, which you can see here in orange, is essentially the on-chain market cap. What it's describing is the value of every coin at the price when it last moved. Now you can see here we have the market cap in white, and you can see that the market cap typically through most of history trades some distance above the realized cap. The realized cap tends to be a lot slower, but it's much more representative of the capital invested in Bitcoin, because if you withdraw your coin at $10,000 and it then moves again at $50,000, somebody else had to come in with that additional $40,000 times, whatever the Bitcoin value was. So it really represents the amount of invested wealth. So one way to think about it, it is the on-chain cost basis, it is the on-chain market cap, and it is the total wealth stored in Bitcoin, saved at the price when it last transacted. So it does have a bit of a liquidity element. If the coin doesn't move, it's kind of trading around on an exchange, and until it really gets withdrawn, there's that extra layer of a decision to say this coin is now self-custodied. It's one extra step or two extra steps away from just hitting the big red button that says sell or buy. So in that way, it's a much more accurate and liquidity adjusted measure of valuation. Now, the realized cap HODL waves are, for me personally, one of my favorite metrics. They're really, really powerful. You may have seen the HODL waves before. The HODL waves in their standard format look at the total supply broken down by age bands. Now, in the warmer colors down the bottom here, these are very young coins that transacted in the last day, week, month, 3 months. That's the story. In the traditional HODL waves, we're looking at on a BTC denomination. So of the total supply, how many of the coins themselves are actually in those buckets? Now, generally speaking, some people obviously think about things in terms of BTC value, but the problem with the original HODL waves is that Satoshi's coins, for example, so there's 1.1 million Bitcoin which are over 10 years old, they would otherwise be in the purple zone, which as you can see in the realized cap HODL waves, is extremely small, basically non-existent. So why is this? Well, Satoshi's coins, whilst they may represent 1.1 million BTC, they are significant in terms of the coin volume. What was the price when they last transacted? It's effectively zero. Now, most people think about their investment in terms of the dollar value. This is how most people make their decisions in markets, and with Bitcoin, it makes sense to, at the very least, conceptualize things with that price element in mind. So what the realized cap HODL waves are, they are more or less the USD invested HODL waves. This is showing the distribution of wealth invested in Bitcoin. So let's just think about this from a very, very high level, and then we'll get down into the details. During bull markets, we obviously see the media pick up, people start to tell their friends about it. What generally happens is the pool of investors increases, the capital inflow increases, but the characteristics of those investors moves away from the hodlers, the people who study this thing in the deepest, darkest bear markets and know why they own it. And the wealth transitions, as you can see with these warm colors, towards brand new speculators. This was me back here in 2018. Very, very first thing I ever bought in my life was Bitcoin at the absolute top of the bull. So I was a very unsophisticated, uneducated, unknowing investor thinking I was doing the exact right thing when it was the exact wrong thing. Now, what happens during bear markets? You get the exact opposite. The price insensitive hodlers, slowly but surely, the speculators leave, the insensitive hodlers just slowly accumulate, take those coins off. It's a long, slow, gradual, boring, painful process. But these cooler colors, those older coins, swell in scale. So that's the macro view, but obviously this happens at all time frames. You get these bursts when you get these older coins get spent. Remember, coins can be binary. They're either old or young. They can't be both. So for young coins to increase, it means your old coins were spent and vice versa. This is where we can see the capital rotation occurring. Now, just as a quick hint, we've actually recently rolled out so you can pull the Realized Cap HODL waves into Workbench now. And that's actually what we're about to explore, a series of charts where we actually look at each of these individual components. So we've been experimenting a lot with these. You can calculate cost bases models and capital rotation, all sorts of things. So if you are playing around with Workbench, be sure to pull this in and have a bit of a test. Okay, so what I want to explore is this idea of macro capital rotation. What we're trying to look at is which cohorts of investors describe the smart money, those longer term investors, and which ones are more the hot money, the speculators, the hot ball of money that's, more price sensitive, but typically kind of swells up during periods of demand. One represents supply. The existing holders tend to provide the supply because they buy it all in the bear and they distribute it in the bull. In the bull market, the demand is much better represented by that hot ball of money. So that's the concept we're trying to go with here. So first things first, we're going to look at all of the wealth held in coins older than 3 years. Why did we choose older than 3 years? Well, there's a couple of reasons. One, Bitcoin has historically, not necessarily forever, but has historically had about a 4-year cycle. 3 years really captures the last cycle. Now, what we can also see is that this is in percent of the wealth held, or in other words, percent of the realized cap held by these age bands. You can see that we're getting up to about 3.5% by these two older age bands. This is the 3 to 5 years. Sorry, this is 3 to 5 years in green and 5 to 7 in blue. So even if we add these together, we're talking about sub 10% of the total wealth held is by these groups. Now, you can also see they don't necessarily exhibit an overly cyclical behavior. When you've held your coins for more than 3 years, you become much less price sensitive. You're more likely to have this kind of long-term investment, and whether you're buying or selling based on price is potentially even less important than if you're just buying or selling based on your lifestyle. If you hold your coins for 7 years, for example, for at least in Bitcoin's sake, there's a very good potential that, if you were buying back here in hundreds of dollars, sitting up here at 26,000 or 27,000 is it's less important to these people. So these long-term, not only are they small in total wealth, but they also aren't overly cyclical. So what we're going to do is, just to simplify this model, we're actually just going to discount these people, and we're only looking at the active investors. We really care about what happened in the last cycle because they're the most likely people to actually respond as the market develops. So what we've got here is 6 months up to 3 years. In the orange, we've got our 6 months to 1 year. In the green, we've got 1 to 2 year. And in the blue, we've got 2 to 3 year. And you can see that the people who bought here held and became the green here, who then some of those held and became the blue. This is this this maturation of supply. And note, not all of the supply makes it to the other side, right? Some of these people actually sell and spend. So there's a much smaller distribution that actually makes it to the blue zone, which is that 2 to 3 year bucket. Now, as we mentioned at the start, this swelling of this kind of aggregate group tends to occur during bear markets. And note that the 1 to 2 year typically peaks. Maximum wealth is held by these people around the bottom of the bear. We can see it here again in 2018, and we can see it again as FTX blew up. We had the maximum wealth held by the 1 to 2 year old cohort. So what we're going to just do is simplify this model and say, let's just take this 1 to 2 year. It appears to be roughly around the middle, and by definition, it's the middle of these groups. It's a fairly good representation of when that wealth has saturated the hodlers, the probability of a bear market floor has increased, and we therefore start looking at what comes next. So let's take the 1 to 2 year as that smart ball of money, right? That hodler kind of cohort. They're willing to buy during the bear, weather all of the downturn, and survive to the other side. So then we look at the younger groups. We're looking at all of the groups under 6 months. And we can see the exact opposite. This will obviously peak during the bull market. And when nobody is talking about Bitcoin, this is when the hodlers get to work actually establishing a market floor. And again, this is not a property that is unique to Bitcoin. Gold has this cycle. Commodities have this cycle. Stocks have this cycle. It just happens to be we can see these investor patterns playing out at 10-minute resolution using on-chain data. So when the asset is at its most hated, and nobody is talking about it, the media hype has died down, and nobody wants to tell their friends about how much money they lost in the bear market. These things are much less common. This is usually when the hodlers are seeing their maximum wealth distribution, and the fast hot ball of money is at its minimum. And likewise, in the exact opposite, the hot ball of money is investing the most when we hit the cycle peak. This is, again, people buying at the exact wrong time when the smart money is spending and the new money is buying the top. Now, what we're going to do here, I won't go through the actual construction, but we're going to take the coins less than 1 month, because that really represents, similar to how the 1 to 2 year was kind of this like nice middle ground that just tells us the story. Coins less than 1 month is approximately the same for this younger cohort. And if we plot these two out next to each other, you can see the capital rotation. This is peak hodlers when the blue shows up, and then the transfer back to peak speculator. At peak speculator, we have the lowest amount of hodlers. When we have the lowest amount of speculators, we have peak hodlers. This is the Bitcoin internal market cycle plotted out using those less than 1 month, the hot speculator money, and the hodlers, the 1 to 2 years. Now, naturally, we can break this down and look at all different groups. In fact, if you really think about this, there's a bit of a curve here that shows how the average age of coins moves. This is what the HODL waves are really telling us. There is this average wave speed as things move through and coins change from hodler to speculator and then from speculator back to hodler. This is the process of capital rotation. And as you can imagine, there's these spikes here and there that occur. So internally on market rallies during bulls, there is also these details in terms of how coins go between these different age buckets. So what we're going to do now is actually distill this down into an indicator. Now, you can see here that we get basically their local maxima, local minima. They essentially move inversely to each other. And what we're going to do is just take the difference between the two and actually look at when do we have peak hodler, and in the purple ratio we've got down the bottom here, that's going to be high positive values. And when we have peak speculator, large negative values. So you can basically plot out and map out the overall capital rotation through the Bitcoin network as it plays out using these tools. Now, some of you who've been around the on-chain space for a while may recognize this concept, because this is actually what we look at when Philip Swift came up with the R-HODL ratio. It's essentially coming off the exact same logic. We're looking at that 1 to 2 year age bracket, and from memory, he uses the 1 week old as the kind of hot ball of money. And you could really play around with all these different dynamics. And the more we've looked at these different, combinations of, do you do 1 to 2 year or 6 month to 3 year? When you look at these different combinations, you can find all sorts of different insights. But here we've simplified it just down to that 1 to 2 year versus younger than 1 month. So that's the first approach. And again, that's all based on the realized cap. There we're looking at the proportion by age bands. Now what we're going to do is go through a very, very similar exercise, except I mentioned at the start about cost basis models. And where your cost basis is typically what drives investor behavior. Because why? Well, profit and loss is what drives markets. People, generally speaking, come into these assets, they buy and they sell because they see some kind of profit or loss. If you see your coins go into a profit, you're more likely to hold them, but eventually people like to take those profits. Likewise, there's only so much of a drawdown that people can handle. It's only the price insensitive hodlers that actually make it to the other side of a bear market. So you'll all obviously be familiar with our short-term, long-term, and realized cap. These are the cost bases for long-term holders, short-term holders, and the market by and large. Now in purple, this basically highlights when the spot price is below all three of them, meaning it really doesn't matter when you came into this market, you're essentially underwater on your position. Now, one thing I really want to highlight here, we're going to focus on this purple zone. Note that the short-term holder cost basis, which typically trades much higher than both of them, tends to descend below both towards that late stage bear. What this is actually telling you is that these long-term holders who weathered all the volatility, they made it all the way to the other side of the bear, they reached their long-term holder status, and they still underperformed the guy who bought yesterday. That is a really, really brutal reality of the Bitcoin market. This is what these 75% drawdowns, people buy all the way up and all the way down, and their cost basis gets higher and higher until those people who actually had the patience to wait until the final capitulation level, which again, on-chain data helps us identify, we can start to see that this is where these floors get put in. Now remember, the short-term holders who are actually buying down here, we covered this back in January, I believe. These are actually long-term holders by definition of who they are as a person. To have the high conviction to buy when FTX had blown up and Bitcoin was dead for 10 years, yes, they're a short-term holder because their coins recently transacted, but think about the level of conviction you need to have to be this person. So down here at these cycle lows, even though they are a short-term holder by technical definition because their coins recently moved, we can layer on our analyst perspective and go, well, what kind of properties would this investor have to have? A fairly robust case for why you want to own Bitcoin is probably one of them. So again, we can look at these from a technical perspective, but you can always overlay that analytical perspective just to add that extra color. So really at the bottom of a bear market is really that only time when the short-term holders are actually some of the highest conviction in the market. And we are now starting to move to this realm where that is less true. We've now got speculators who've seen the market rally pretty much 100% since the lows and has been tussling around this $28,000 level ever since. Now, the last thing I just want to touch on, kind of an adjacent point, we are in the process as we speak of retesting the short-term holder cost basis from the undersides at about 28,000. So that is a key psychological level to pay attention to. If we get above and hold that $28,000 level, those short-term holders who've been underwater for a couple of weeks since, in early September or late August, they are now back into profit on average. And that could potentially be a strong indicator for market sentiment. A rejection from there, obviously, would tell us the inverse. Now, we're going to take those cost basis models and we can either develop something like MVRV, which just takes the ratio with price, or we can do NUPL, which is net unrealized profit and loss. It's essentially MVRV, but transformed in a slightly different manner. We're looking at what proportion of the holdings of those different cohorts are in profit or loss. Now, what you can see is that long-term holders are in the maximum profit at bull market tops. They're also, as we said before, they move into the largest unrealized loss because they buy and hold at high prices and carry that the whole way through the bear. So the blue actually tends to hyperextend on both extremes, certainly relative to the short-term holders. You can see at these bear market floors, when the short-term holders get in, they actually have a very favorable cost basis because by definition, they bought the bottom. Whereas long-term holders typically sell the top, but also hold too long on the downside. So you can see we've got a very similar pattern, this kind of extremes when the long term and the short term start to deviate at large magnitudes from each other towards market cycle extremes. Well, we're going to take the exact same model and take a difference between those two NUPL curves. And you can see that we get maximum levels during the bottom of bear cycles. This is when long-term holders have actually weathered the whole bear and they still underperform the guy who just bought. And conversely, when long-term holders have the maximum profits, this is when the market is super overheated. There's a lot of people carrying lots of profit. And what typically happens when people have lots of profit? Someone starts to spend. And that spending typically ramps up until the point that it overwhelms the new demand coming in. This is a really important point. The long-term holders are the ones that actually stop the bull market from progressing because they sell so many coins that they overwhelm demand. So whilst the market is the most exciting, the media is the most hyped up, at that point in time, that is actually when the maximum profits are being taken. Long-term holders are exiting the market. They're going to oversaturate the demand at some point, and you have, let's just go back and close this thing out with our realized cap HODL waves, you have the maximum saturation by brand new investors who've only heard about Bitcoin yesterday and they've just bought their first coin, and they are going to be the most price sensitive. They also have a high cost basis. They become very sensitive, and that is essentially what terminates the bull at the end of the day. So thanks for tuning in for that session, folks. Hopefully you found that useful. A little bit of an exploration about how coins move around between different investors and really just bring it back to just how powerful the Realized Cap really is. It is a foundational tool that we build a great many of these metrics and tools off the back of. And really, it comes down to the very simple concept of capital inflows and outflows and profit and loss, which are the motivating factors that cause investors to make decisions. So until the next one, I'll see you then. Cheers.